kick off this afternoon, just before we jump into non-cash gifts, there's one idea that we were running kind of tight there at the end before lunch that I decided to wait to share with you. And this is a marketing strategy for planned giving. And I had a slide on there that talked about different donor recognition societies, the ways we recognize donors, annual lists, plaques. How many of you have donor recognition, like a list of all your annual givers every year? Yeah, some charities have levels, like even annual giving. You have this tier and then this level, and you use those levels to encourage people to go up in their annual giving. So you have gold, bronze, silver, however you do it, or you have names to those levels. So that's annual giving recognition. Some charities have cumulative lifetime giving. So once over the course of your life, you've given us 10,000 or whatever, you're now in the Eleanor Roosevelt Society, and you name it after either somebody who's in that society or, again, somebody whose story is very inspirational, and you have cumulative lifetime. Other charities have a society or group for all people who've given to their endowment fund. At the community foundation or elsewhere, you list all those names of people, and you call that a legacy or heritage or bridges to tomorrow, something like that, society. So again, you're calling recognition, saying a special thank you, shout out to folks who've done that kind of special gift. Another one I want to share with you is the idea of, for anybody who's included you in their estate plan, a will bequest, retirement plan designation, or life insurance designation. Maybe they did something as exotic as a charitable remainder trust or a gift annuity. And you're never going to have a lot of people in this club. It's always going to be kind of a small number. And even if you can start with 3 to 5 names in it, that's just fine. Because it's going to be slow and it's going to build slowly over time, and it'll never be a huge number, okay? Another strategy with a group like that is you say, for those who tell us about their planned gift or decide to do one within the first 2 years or whatever, you'll forever be known as charter members. And you'll have a gold star by their name, and they'll forever be charter members of the society. And we did that at Ball State. Before I got there, they did it. And those charter members, that meant something to them. They were those who helped get this thing started. So who would you go to for your charter members? So you advertise it, and believe me, before you kick something off, you'd like to have 3 or 5, birds in hand, right? Because you don't want to embarrass yourself and enroll it and nobody's there. It's like throwing a party and nobody shows up. So who do you go to for your first 3 to 5 members of your planned giving society? Your board, yes. And past board members, right? Who else are we going to go to? Who did I say on the giving pyramid are those low-hanging fruit for planned gifts? Loyal multiple-year givers, yes. Find those donors who've been the most loyal. Hopefully you can track this out of your database. Who's given the most number of years in a row? And you could start with those who maybe have given the highest dollar amount most years in a row, but even low dollar amounts would be just fine. Go ask them. That's a great way to ask them to consider a planned gift. You could go to them and say, now I don't know if you've ever considered this, but we're starting, we've got some names of others who are helping us kick off a new planned giving society of those who've included us in their estate plan. And as you know, we're so thankful for your loyal annual support over the years. Just let me thank you for that. Did not know if this would interest you, but I wanted to share this with you, and we're hoping you might consider becoming a charter member of this group because of your loyal support for us. And they'll probably say, well, I'll consider it. That's what you want them to do. You don't maybe expect them to say yes right there. They might say yes right there. They might say, you know what, I've already done it for you. They might say that. So now you found out of Mary before she died, right? So do that. Go to that low hang, because people who are loyal givers, they're not going to be offended by that. You're just planting a seed. Here's a question over here.
Are you finding some generational differences with the recognition things? Because I would think, the older World War II generation tends to like those a little bit more than some younger generations.
I've had conversation about that. And I'm not convinced yet that the younger generations are not interested in recognition. But I still think these recognition societies are worth doing. So I go ahead and do it, and then just judge for yourself if the younger people are signing up. That would be what I would do. Yeah.
What kind of documentation, if any, are you asking?
Well, right. You'll hear different opinions about this. My opinion is that if they will inform you that you're in their estate plan, that's enough. Now, I have an acceptance form or even a letter from them or a note, something where they've kind of an email from them, where it's something from them, signed by them, or an email from them that says, I've done it. It could be like a pledge letter you have them sign, that they've included you in their estate plan. Now, what I say to folks is, it's really helpful to us to have a copy of that portion of your will, your retirement plan designation, whatever, indicating the gift for a couple reasons. One is, we want to make sure you've got our name spelled correctly, and so there's no problems like that. We'd like to have a record of it because, you know, you always say, you know, it's going to be many, many, many years before we ever see this money. But we'd like to be in a position to help make sure your gift is stewarded to us at that time. And by having a copy of it in our file, we'll be in a better position to help make sure your gift gets here. And that's true. I have had instances where especially with life insurance and retirement plans, but by having a copy of their beneficiary form, I had their account number and I was able to get the job done quicker. And I don't get a lot of pushback from folks willing to give that once I explain it and ask it. I say to them, if you'd like to share a dollar amount, you're welcome to, but your membership in the society is not contingent on stating a dollar amount. If I'm in a campaign, I tell them, if you tell me a dollar amount, we'll count your dollar amount towards our campaign goal, and that's a good leverage point to ask for a dollar amount. But the bottom line is, initially, just get them in the society, but have something from them indicating they've done it. The point here is that these are revocable gifts. And if they go to the extent of telling you about it and then saying yes to recognition for their gift, you have done just about all you can do to make a revocable gift irrevocable in their heart. Because this is what we're dealing with here, is their heart. So, you know, if they say, I've done it, and yeah, I'll be in that society, I'll let you put my name up there, you know. And you want them to sign it because also that's proof that they've given you permission to state their name publicly. Now, there will be people who say to you, I've done it, but I don't want my name on that list. Okay, that's fine. But thank you for telling me you've done it. I put them down on a separate list, so when I tell my board how many planned gifts I have, that's on another list, and not with the named society people. Yeah.
Yeah, I just wanted to comment on your question because I was at a conference yesterday with Michigan Nonprofit Association, and one of their seminars was about millennials.
Yes.
People who are born between 76 and
Yes.
96. And one of their motivators, especially in the workplace, and I
Yes.
assume it would transfer,
Yep.
is recognition. They like
Interesting.
to see their name somewhere. They like to have, you know, promotions and titles and things like that. So I would assume that, I don't know about the boomers. I should know, I'm one of them, but I don't know. That the younger ones would, you know, it may not be as generationally specific as we might have originally thought.
Yeah, I would keep going with the recognition, you know, until convinced otherwise. So your name of your society, and what would you do with that society? You're going to invite, even if it's 5 people, you're going to invite them to a lunch, and what's going to be talked about at the lunch? Your programs, you're going to have your CEO there, your board chair there, you're going to have staff there, people maybe you've served there, and they're going to hear the latest news. You're maybe going to give them a tour. You know, you're just cementing that bond with them, right? Okay, we're going to shift gears now, and we're going to talk about non-cash gifts. When we talk about non-cash gifts, we're talking about property gifts, and there's 3 kinds of non-cash or property gifts people can make. Intangible personal property, real estate, and tangible personal property, okay? Intangible personal property are things like stock and bonds and copyrights, intellectual property, things like that. So the piece of paper or the electronic ticker name that a stock has or bonds, the value is not that piece of paper, it's what your ownership of that paper or that item represents on a marketplace somewhere, the New York Stock Exchange, a bond market, mutual funds, another example. That's what it is. course, we all know what real estate is, so I don't have to go into that. But tangible personal property, now that is property where the value of it is inherent in the item itself. Are you with me? So an automobile, artwork, jewelry. See, the value of that piece of tangible personal property depends on what? The age, the quality, who made it. You see what I'm saying? The value is contingent on the asset itself. So I just want you to have in your mind, there are three kinds of non-cash items that people own and have and can make gifts with. And as it turns out, gifts of each of the three types of property have different implications depending upon the type of property. The tax benefits, how you make the gift, all sorts of aspects depend on whether it's intangible personal property, real estate, or tangible personal property. So I want you to have the big picture. Yeah.
Can you talk a bit about savings bonds? I don't know if anybody else experienced this, but with my parents, they had savings bond taken, out of my dad's check for his entire career.
U.S. savings bonds.
U.S.
Right.
savings
Right.
bonds. Many of them are starting to roll over
Right.
now,
Right.
and there's a tax implication.
Right.
If they were to donate those, would there still be a tax implication?
Yes. Yes.
There would be.
There would
Okay.
be. We're going to talk, well, we can talk now about bonds. Bonds, which kind of property are they? Intangible. Now, but here's an example where a particular kind of piece of property just has unique aspects to it based on the kind of asset it is. So with U.S. savings bonds, remember, U.S. savings bonds, these are ones you make a gift for or you buy, and they build up interest, right? And then at the end of it, you get the original amount back plus all the interest. If you, however, make a gift of that U.S. savings bonds, you're going to owe income tax on that accrued interest. And by giving the bond away does not mean you escape the income tax. You still get a tax deduction for the value of that bond, but you would still owe the income tax. So as a result, I've never seen a gift of a U.S. savings bond, really. People just don't do it because it'd be better to give something else. If I'm going to make a gift, I'm going to make a gift of something else. Because with the U.S. savings bonds, the tax liability and the deduction might wash each other out, and I don't even get a net deduction off of it. See, the tax liability might offset whatever deduction I get. That's the problem. But that's a great question. So in addition to bonds, a more attractive non-cash gift, a more popular non-cash gift, are gifts of stock, okay? Now, there used to be a word associated with gifts of stock called appreciated stock. Do you remember what appreciated means? That means you bought it at one price and it went up in value. And then when you sold it, you would pay what? Capital gains tax. So capital gains tax is a tax when you sell capital assets like stock that have gone up in value. Capital gains tax can also apply to real estate and other capital assets. All right? So capital gains tax, does anybody know what the capital gains tax rate is now? What's the rate of that tax? 15%. Remember I said this morning that I was in a state of bliss early in my career, working only with World War II generation donors? I was also in a state of bliss because capital gains tax rate for that 10-year period was what? 28%. Now, why would I say that I'm in a state of bliss as a fundraiser when capital gains tax rates were higher? If you can answer that question, you're thinking like a fundraiser.
Because people would be more willing to donate it to avoid paying the 28%.
Exactly. Because when you donate appreciated assets, do you owe the capital gains tax? No, you escape the capital gains tax. So my point is, if I had an asset that when I sold it, I'd owe capital gains tax on, if instead I give it away and the charity sells it and gets cash, They don't owe capital gains tax, nor do I own capital gains tax. The government gives it away. They give away that capital gains tax liability because they love us charities. What's the other tax benefit when a person makes a gift of stock? Can anybody tell me?
The donor still gets the tax benefit from the donation.
That's
itself.
right. It gets the tax benefit for the donation. So they give you 100 shares of Ford or GM stock. How do we determine the value of that tax deduction?
The value on the day of the gift.
What is the date of the gift for a stock gift? We got 3 options for date of gift: when it's sold, when it's received, when it's sent. The date of the gift depends on the method of delivery. Ooh. What are the different ways that a person could deliver a gift of stock? By far the most common is they wire stock. People electronically wire stock from their account to your account. The same banker or broker that you go to give you wiring instructions for cash for the IRA rollover, you're going to also, to make your time efficient, say, I also want wiring instructions for a donor to wire stock to our account. So with stock that is wired, when do you think the date of the gift is? It's the date that it's received. And this is a very kind of basic, important rule about all charitable giving and the tax benefits of giving. In general, the gift is complete when who owns the asset? Charity. Because up until the point you have ownership, what can happen to that gift? They can say no. They can pull it back. See, actual delivery of legal ownership is essential to completion of the gift, whatever kind of gift we're talking about. Okay, so that's for wire delivery. How else can people make gifts of stock? Well, people, my World War II generation donors, what did they have under their mattress? Remember that? Stock certificates. Boy, I'm getting old. Have you ever seen a stock certificate? On the back of a stock certificate, there's usually a form that says, I deliver ownership to, and they sign it, and that's the way to deliver it. A safer way to do it is, in addition, don't have them sign the back, have them sign what's called a stock power form, and you can get those from like Staples, or your law firm can help you, or your accounting firm. A stock power form, which basically is just a form that says, I hereby give XYZ stock, fill in the name to charity, and they sign it. So it takes the stock certificate and stock power form together to go cash it in. I started with stock because nationally, internationally, a lot of major and planned gifts are made with stock. It's a very important asset for major and planned gifts. Now, most charities have a policy made by the board that says once the stock arrives in your account, it is to be sold immediately. You know, those donors know how to pick their stocks to give away, and they pick it at the right time, just before it goes whoop. Not always, but it happens. So if you have a standing policy with your bank or broker that when it hits your account, it is sold immediately, liquidated in cash, and then the cash you either then invest in your endowment at the community foundation, or you send it, or the bank or broker sends it to your finance office at your charity, and it's available to spend, or if it's for a designated purpose, the donor may designate what they want that cash used for. What's the third way people could make a gift of stock? They could take that certificate and put it in the mail. Now, for any type of gift that is mailed, I don't care if it's stock, a check to you, they put money in an envelope and mail it to you. There is a law that says the date of that gift is fill in the blank. Postmark date, A+, right up front here. It's called the postmark rule. It's got its own name, the postmark rule. All right? Yes, sir.
Let's say the stock exists within the bequest of a will. Is it the date of delivery after the will goes through probate? where you actually receive it, or is the date of death?
It's the date of death. You can actually, when a estate's in probate and you find out about it, you can book that on your financial statement. Great questions. I just love you guys. Yeah, question.
What happens if you are gifted with stock?
You're happy.
Yes, but what if it depreciates before?
Oh, God, I just see, there it is. That's,
Do you-
so,
do you even
okay,
wanna take
all right.
depreciated
Do you
stock?
know what depreciated stock is? We should, right? Because depreciated stock is stock you buy at this price and then it does what? Goes down in value. Should people ever donate a depreciated stock? Well, think about that a minute. When you sell depreciated stock, you're not going to owe capital gains tax, right? Don't you get a tax benefit when you sell depreciated stock? What do you get? A deduction for the loss. So when stock goes down in value, that amount of drop is a deduction for the loss. See, the IRS, they're our friend. They're giving people whose stock is a loss a deduction for the value of the loss when they sell it for that tax year on their tax return. Now, you're so sad. You're so sad that your stock went down and you had to sell it. And now you got cash from that sale. The only way to make yourself happy is to do what with that stock? Who said that? Donate the cash to you. And if they donate the cash from the stock they sold, depreciated stock they sold, do they get a charitable deduction for that gift of cash? Yes. I've coined a new phrase, the double deduction for depreciated stock. Love alliterations. The DDD, double deduction for depreciated stock. So they should never donate the depreciated stock to you. They should sell it, take the loss deduction, then give you the cash. They don't have to give you all the cash. Even some of it would be okay. And then they get a charitable deduction for the gift of cash. One other thing I want to talk about valuation of that stock. So we now know the date of the gift, depending upon the delivery method of the stock. How do we value the stock on that date of gift? You take the average of the high and the low. So that means on a date, at any particular date, you can go to Yahoo Finance or any one of a number of internet sites and look up for any date, and they go all the way back to the dawn of time. And you can find the high and the low values. You add those two values together and divide by 2, right? That's the average. And that number multiplied by the number of shares is the value of the gift. So it's the average of the high and low times the number of shares. Mutual fund shares are kind of like stock, right? The only difference is that quite often you cannot wire transfer mutual fund shares from the mutual fund company to your account. Quite often you've got to open an account at the mutual fund company into which the mutual fund shares are transferred. I'm just giving you a heads up. Has anybody ever done this? But you know, there's trillions of dollars in mutual funds out there too. Now, mutual fund shares don't have a high and low. They have a close value. So there's no high and low. It's just a close value times the number of shares. So that's mutual fund. Now, I've got to give you a big warning. This is very important. Are you listening? Is everybody listening? When you get stock in your account, the donor has wired you the stock. Are you listening? It is not arriving with the donor's name on it. Did you just hear what I just said? When that stock arrives in your account, you have no idea who that came from unless that donor told you ahead of time or their broker called and told you ahead of time. So that means when you're promoting gifts of stock, you tell your donors, please call and let us know when you're ready to make the gift. Then we will send you the delivery instructions. That way you have some control over the process. That way they can't send you anything until you know they're going to do it. And then you can ask them, oh, by the way, what stock are you sending, about how many shares? Because, you know, that'll help us keep an eye open for it, because otherwise we wouldn't know it's yours when it's coming. We're getting so many gifts of stock, we don't know where it's all coming from. But you need to know that. And believe me, if there's one magic wand I could wave and change, it would be to fix this delivery system so that the donor's name would be, the owner of the stock's name would come with it, but it just doesn't work that way. Okay? I want to go through some basic rules around non-cash gifts. One rule is, on your gift receipt for stock or any non-cash gift, are you required to put a dollar amount value for that gift? No. No. I advise that you don't put a dollar amount. Whose responsibility is it to assign a dollar value to a non-cash gift? The donor. It's between the donor and the IRS. Your job is to do what? Acknowledge receipt of the non-cash gift, okay? This is our receipt or acknowledgement letter for a non-cash gift. Dear name, on behalf of your charity, thank you for your generous gift of XYZ. XYZ is what? The law says describe the property in sufficient detail to kind of get it. You know, you don't have to kill this, just 100 shares of Ford, the piece of computer equipment named, IBM number, blah, 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 whatever. And then on date of gift. Okay, my favorite IRS publication is IRS Publication 1771. Here are the requirements of what should be on the gift receipt. The name of your organization, do you see it? Number one. The amount of a cash contribution, if there's cash. A description, but not the value of non-cash contribution. Number four, statement that no goods or services were provided by the organization in return for the gift, if that was the case. Number five, description and good faith estimate of the value of goods or services, if any, that an organization provided in return for the contribution. I call this the keychain rule, right? The most classic example is the fundraising dinner, where it's $100 to come to the fundraising dinner, the value of the meal is $20, so their deduction is $80. And you've got to tell them, you have an affirmative obligation to tell them that the value of that meal is $20. They're not talking about names on a recognition plaque, they're not talking about trinkets, small value things, but things of real financial value back. The IRS is saying, well, that's not part of your gift. You're getting something back there. That's a deal. That's not a gift for that part of it. Yes?
So if I'm reading this correctly, the IRS doesn't require that the organization give the date the gift was received?
Oh, I love that. This is a really smart group. Now, I have actually gone into the IRS regulations on this, and it seems pretty clear to me that date of the gift has to be on the gift receipt. So when asked for a legal opinion on this, my answer is put the date of the gift on the gift receipt, even though on page 3 of this publication, it's not on the list, even though it's on page 2 of the publication, but the regs make it pretty clear. Other question?
Especially with direct mail gifts, they're mailed to our lockbox, so
Yes.
they're going to the bank.
That's cool.
So would it be the date that it's actually deposited? Because we get a lot of checks that come
Mailed?
in. Well, what comes back to us are copies of the checks and like remit slips.
If it's mailed to an agent of you, like if it's mailed to your bank, they are your agent. They are acting legally on behalf of you, but it's still a postmark rule.
But we don't get those envelopes back with a postmark.
Well, yeah, it's a problem. The IRS is one day is going to have to address this. Your worst case scenario is their donor's audited, and it's a really big gift, and they really need something to prove that it was December in the prior tax year. I guess my advice would be, if you can get those envelopes imaged, that's good. And with really big gifts, I would worry about it. And I would definitely keep those envelopes for bigger than normal gifts, because they're more likely to be audited. Now I want to talk about the 8283 form. And it's very important. It says non-cash charitable contributions. This is the form that a donor has to file with his or her tax return to claim a charitable deduction for any non-cash gift when the deduction is over $500. So anything under $500, they don't need to worry about this, okay? And if the value of the deduction is over $500 but under $5,000, we only use this front side. It's called Section A. Now, it's not necessarily just $500 for a single item, but if they donate a group of similar items, the sum total of which is $500 or more, then they have to fill this out, okay? They've got to put information on donated property, name and address of the donee organization. That's you, your name and address. Part B in Part 1, description of donated property. For donated vehicle, enter the year, make, model, condition, and mileage, and attach Form 1098C. 1098C is a form that you fill out. You give a copy to the donor, and you send a copy to the IRS. 1098C is what's used for automobile gifts. At the bottom of Part 1 on Section A, if the amount you claimed as a deduction for an item is $500 or less, you not have to complete columns D, E, and F. And there's date of the gift, date acquired by donor, how acquired by donor, cost basis, fair market value. And then Part 2, partial interest in restricted use property. A partial interest gift is when they give you partial or restricted use of the property. An example would be, I own a piece of real estate, and you want that real estate, and I'm going to give it to you in pieces over time. And I'm not going to carve off pieces and give it to you. Rather, I'm going to give you an undivided 10% interest in the whole. So that I spread out my tax deduction over a long period of time. So you'll own 10%, and then the next year you'll own another 20%, but over maybe 5 to 10 years, you'll end up owning 100% of this property. That's kind of a partial interest gift. Now let's go to the back, Section B of this form. The back is completed if the deduction claimed is over $5,000 in general, except for publicly traded securities. So gifts of stock over $5,000 value, you only fill out the front of this form. In Part 1, again, more information on the donated property. Art, collectibles, conservation easement gift, real estate, intellectual property, equipment, securities, and other. And then C, under Part 1, Section 5, all sorts of description of donated property. If tangible property is donated, give a brief summary of the overall physical condition. Is it in good shape? And appraised fair market value. And then down below that, date acquired, how acquired, cost basis. They're trying to see what the appreciation is. Lots of information. This is for tax deduction over $5,000. Now, the donor is filling this out. You're not filling it out. I'm just making you aware of the form. They're going to a lot of work on your behalf, right? Yeah. Question?
Just real quick for a clarification, because we talked about stocks that depreciated. What about real estate that is donated but back taxes are owed on it? And we want the property and we want to pay the back taxes.
Right. Anytime you accept a gift, whether it's real estate or anything else, and that gift comes with liability, a mortgage, a debt, past taxes, and you pick up those costs associated with it, especially if it's mortgage or debt, the value of the deduction is reduced by the value of the debt. But yeah, if you're not going to clear enough to pay the mortgage, there's no reason to take it. Right. Okay. Now, further down on here, very important, Part 2, the taxpayer signs this form attesting to its truthfulness. Part 3, appraiser signs the form. For any non-cash gift over $5,000 deduction claimed, a qualified independent appraisal is required. Who pays for the appraisal? The donor. Don't you get in the middle of that. My general rule is that charity pays for the expenses of a gift that protects the charity's interest. The donor pays for the expenses that protect the donor's interests. So, for example, with a gift of real estate, the donor pays for the appraisal. That protects his deduction value interest. You, the charity, pay for what? The deed preparation, so you get good title. You pay for the environmental review to make sure it's clean. You're protecting your interest now at this point. Appraiser signs it. The copy of the appraisal doesn't have to go with the tax return to claim the deduction, but it has to be dated within 60 days of the date of the gift. And if audited, the IRS want to see that appraisal, and it's got to be dated contemporaneous to the gift. Are you with me? And look at Part 4 at the bottom, donee acknowledgement. A representative of your charity signs this form, and your board of directors should identify who in your charity should be appropriate for signing these kinds of forms. Your signature in Part 4, nowhere is the IRS saying, nor is it implying, that you're attesting to the value of the gift. You're only acknowledging receipt. However, this has been a very hot topic. If staff thinks that the donor is claiming an obviously inflated value that has no tether to reality, my advice is you have a board-approved policy of what you're going to do. Maybe it means you're going to tell your CEO, maybe your CEO talks to a board member. I don't care what it is. You have a policy so that someone high in the food chain is making a decision about signing this thing. Now, if it's really bad, what it ultimately means is a conversation. If you're having a difference of opinion of a few $100s, I just wouldn't stress out about it. But if it's a big non-cash gift value and you feel like they're like doubling, tripling, 10 times the number, you got to sit down with Bob and say, Bob, we're really worried. This is an audit problem, and the IRS is mad at charitable organizations for signing forms when we're concerned that the value is inflated. Would you please reconsider this? That's a tough conversation, but that's what you got to do, I'm sorry to say. I want to highlight a few key things here. The 8282 form is filed by you if you sell donated assets or non-cash gifts within 3 years of the date of the gift. You do not have to fill out the 8282 if the sale price is less than $500. But if you sell it for more than $500, you've got to file the 8282 with the IRS. And the IRS is comparing the donor's tax deduction value claimed on their 8283 with what you sold it for on the 8282. And if there's a more than 10 or so % discrepancy to the benefit of the donor's deduction, that's going to be an IRS audit red flag. All right? You are to give a copy of the 8282 to the donor. If I sense there's going to be a problem selling the property for within 10% of the value of the deduction, I'm going to have a conversation with the donor. Now, you ought to be having that conversation before you take the property. Now, with the sale of publicly traded stock, no matter how valuable it is, you do not need to file the 8282 form. Now, it's acceptable, even with property, to have a buyer waiting in the wings. But you cannot have a prearranged sale, or else the donor will owe the capital gains tax. It's called a prearranged sale. That's only if there's a signed legal agreement obligating you to sell to that third party. But just don't sign anything ahead of time between the donor, you, and the buyer prior to the gift. Okay? Now, another publication I want to point out to you. See what the title of this is? Determining the Value of Donated Property. And look at the table of contents. Every conceivable type of non-cash property, almost, is here. So this is a great resource. And it's one that donors should be looking at as they figure out how to get a qualified appraisal on their donated property. And in the appraisal report that the appraiser prepares, they have to include a description of their expertise, why they're an expert on that kind of property. The appraisal also has to be independent. That means you or a staff member of the charity cannot do the appraisal. The donor or a member of the family of the donor cannot do the appraisal, nor should an employee of the donor do the appraisal. Now, there's another great IRS publication that you need to be aware of. It's called Charitable Contributions, publication 526, page 2 of the publication. Not deductible as a charitable contribution. and look at that list, and I want to highlight a couple of them. Second from the bottom, value of your time and services. There is no charitable deduction for a gift of time and services, no matter how valuable. So a lawyer who gives you free time to review a contract, there is no deduction for his or her time. A doctor who donates time to do a medical exam, there is no deduction for their time or services. Okay? You can give them recognition in a donor recognition society for that time or services. Accounting standards even says that you can book the value of time and services that's donated on your financial statement if it's time and services that you would have otherwise paid for. However, under no circumstances can the donor of those time and services take a deduction. Okay, you cannot deduct property that is loaned. So let's say somebody loans you the use of a computer or lets you use office space without paying rent. There is no deduction for that loan of property. Deductions are only allowable if they actually give you the property. All right? Items donated to your charity auctions, limited to cost basis. That's what they paid for it. Okay? On the other hand, if a person gives you tangible property like equipment or artwork, anything like that, and you use that property for your mission, then they get a fair market value. So I give you a truck and you use it for a scout camp, or you use the truck to haul people or equipment around in, or a van to carry people around in that you are providing services for. In that case, the donor gets a fair market value deduction for that piece of property. That's all explained in this publication. The deduction for food gifts. There's a general rule that whenever a business donates inventory to your organization, their deduction is limited to cost basis, what they paid for it. There's an exception for gifts of food inventory. And that's explained on page 12 of the publication. And there's an actual worksheet here that steps a donor through the calculation of their deduction, which is a certain amount, a percentage greater than cost basis. So there's what's called an enhanced charitable deduction for gifts of food inventory. It's explained here. The worksheet is here. You can share this with your donors, businesses that own food and give you food inventory. And odds are great, they're already aware of this, but you ought to be aware of this as well. One other thing I wanted to point out, page 14 of the publication, there are different deduction limits. First of all, do all people who file an income tax return claim a deduction? No, only if you itemize on your tax return. A large number of people don't itemize on their tax return. So the rule is that you claim a deduction for the value of the gift, and we've talked about how values differ based on type of gift. There's also a deduction limit that's explained in this publication. For non-cash gifts, the deduction limit is 30% of their adjusted gross income. For cash gifts, the deduction limit is 50% of adjusted gross income. All right? So there's a better tax deduction for cash gifts than non-cash gifts. Now, if a person has more deduction than they can claim, they can carry over the excess deduction. And you can keep doing that for 5 years past the year of the gift. So you get the year of the gift plus 5 years. Okay, gifts of real estate. Couple words about real estate. Due diligence is very important. What do we worry about with real estate? Are we going to use it for a purpose, or are we going to try to sell it? If we're going to sell it, can we sell it? If we take it and we can't sell it right away, you might be liable for property tax, etc. And you got to be willing to say no. Your board should have approved gift acceptance policies for real estate. My advice to you is any gift of real estate has to be approved by your board of directors. And only they should consider it after you've done your due diligence. Get a marketing analysis. If the intent is to sell it, what does a qualified real estate broker in this area tell me about the prospects of selling this? Are there any buyers waiting in the wings? Environmental review. You have to have an audit done to make sure it's clean. If it's not clean, don't take it. Your liability could be huge. Be very careful. Debts, mortgages, liens on the property. Are you going to accept those? If you accept those, that means you've got to pay for them. Do you really have the money to do that? There are a lot of issues with real estate, and at the end of the day, your staff should not have the decision-making power, your board of directors, but only after due diligence. All right? Now, bargain sale. Let's say you want or need a computer, or you want or need a piece of land next to you, and you approach a person who owns that computer, a company or an individual, and you ask them, would you consider a donation of that? We really could use it. Their response is, I'm sorry, I love you, but I cannot afford to give this to you. If you have the money to maybe pay something for that equipment or land or whatever, you can buy it for a reduced price, and the seller/donor gets a deduction for the difference. That's a bargain sale. So if you buy property for less than fair market value, the person selling it to you gets a deduction for the difference between the sale price and the fair market value. In addition, if they had sold that non-cash asset outright and paid capital gains tax on it, they are not going to owe capital gains tax on the gift part of the bargain sale. They'll owe capital gains tax on the sale part, the price that you paid, that percentage of the value, they'll pay capital gains tax. But on the gift part of the transaction, the difference, that portion they will not owe capital gains tax on either. The point is that bargain sales can be really helpful if you need the property or the non-cash item. The donor can't give it to you all outright, but you've got some cash to pay something for it. Donor gets cash in his pocket, gets a tax deduction for the difference, escapes a little capital gains tax. You can recognize them as a donor. Everybody's happy.